Waiting for YouTube. Okay, thanks. You're all set.
Okay, thanks. So welcome everybody to the quarterly Town of Orange Pension Board meeting. We'll call the meeting to order, and we'll get right to our agenda, which first item, just to will note, there's nobody here for public participation, so we'll skip over that. The next item we have is to review and approve the minutes from our last meeting on November 12th, 2020, and draft of the minutes, I believe, were sent out in the packet to everybody. So hopefully you had a chance to take a look at them. I entertain a motion to accept the minutes.
Motion to approve minutes of the meeting of November 12th, 2020.
And that's from Barbara Miller. Is there a second?
I will second. Good job, Ann.
And is there any comments, questions, changes?
No.
None.
Being none, okay, all in favor, signify, say aye, raise your hand.
Aye.
Opposed, none, so thank you. We get that approved. Moving right along, we're gonna have, we have Chris Katchmer from, well, I guess, are you still FIA, Chris, or you're now officially changed the name?
Officially the latter, Mr. Chairman, DeMayo Schneider.
Okay, so we now have Chris Katchmer of DeMayo Schneider, our investment advisor. So Chris, you're up.
Right. This is a tidy run through the agenda. We've got the whole 3.5 hours left reserved.
We're gonna have drinks later on. So.
If it pleases the chair and the board, I'll share my screen and maybe we'll just use that visual as.
Absolutely.
Hopefully, can everyone see the orange report?
Yes.
Yes.
We'll forge our way through this and keep you on task here. I think it should be a pretty low-key meeting. Performance was very good in the plans, as you probably noted, and not a whole lot, I think, to tackle tonight in terms of action items. As alluded to, we are kind of fully integrated and are one now under the DeMayo Schneider banner, and integration's going great, and in an odd way, right? Almost by virtue of the pandemic, although I dare say that carefully, we've actually integrated probably at a quicker pace than we had anticipated. Just not being in cars and going to meetings and on planes. We've been able to devote a lot of time to bringing the organizations together thoughtfully. About $200 billion now of assets under advisement across what I would argue is kind of a truly national footprint now, with offices on the West Coast and in the South and in Chicago, of course, and you know us here in the Northeast. And importantly, we do continue to hire and staff the organization across all levels to keep a pace with our growth desires and make sure that we continue to operate in the manner you've grown accustomed in terms of responsiveness and servicing and whatnot. Julie joined us down at the bottom of the page as our Chief Operating Officer. Monica joined us as our CFO, and a host of other well-credentialed hires as well. So we're hitting the ground running here, given the circumstances, which is I think good. Will be good outcomes for clients for sure. We'll skip the accolades here. You can read those at your own accord. And we'll jump right in here to governance. So this quarter we deal with the topic, of asset allocation. And we'll work through a couple of the pages here momentarily, but this is, if you remember, where we just kind of take a pause, look at the way the portfolio is allocated today, test the optimality of that portfolio, and we'll talk to what that means in a minute or two here, and just kind of see where we stand versus what our actuarial expectations are for the program, which today is a 6.25% return expectation on a go-forward basis. So let me kind of hit the highlights here and run you through the process, and then we'll get to the detail. I promise all these numbers already, just accounting for the police plan, the town plan, We're well within the ranges specified by the policy statement, right? So we don't have any challenges right now from an allocation standpoint that we need to attend to. And we'll look at some more detailed information in a couple of minutes' time. And then we start to roll out, the allocation analysis and the process itself. So we have internally between Chicago and ourselves an 8-member capital market working group, and I'm a member of that group. And we sit down every November and December, and we kind of work through a whole host of analyses that relate to expectations for the markets on a go-forward basis. And we're looking at historical data, we're looking at valuations, we're looking at interest rates, we're trying to have guideposts on inflation and how these asset classes may jump around through time and how they may interact together in terms of correlation. And we do all that arithmetic and analysis. And that's the basis for us putting forth capital market assumptions. And alongside that kind of academic exercise, if you will, is we obviously need to interject some kind of real world consideration and just what the world looks like as we begin this new forecast period at the onset of 2021. So again, there's a lot of words on the pages here. I'll try to distill it in 30 seconds time or so. I think our takeaway is, right, we have an awful lot of stimulus in the world, both monetarily in terms of ultra accommodative policies, and we've had one big fiscal stimulus package, as you know, and it looks like there'll be another one forthcoming in the not too distant future. And I think all of that together with hopefully, an expectation that we're able to start to get our arms around the vaccination distribution efforts and maybe pick up some momentum there in the back half of the year. We're constructive in terms of what we think may happen for markets over the course of the next few years. And that certainly doesn't mean that is a stepwise, perfectly stable, no issue type of a progression, but we do think it's a generally positive one. But, we do recognize that obviously there's still a lot to be done in terms of the pandemic. Equity valuations are a touch high right now, given how well markets have done. Interest rates, as you all know, are very, very low. And the incremental compensation that investors are receiving for large segments of the fixed income markets are pretty low as well in the form of those tight credit spreads that we mentioned at the top of the page. I won't go through all of the categories below because I think we've kind of touched on all of them already. But we do think the world is kind of poised, if all these circumstances come together, to maybe begin a new economic cycle. Maybe it's toward the end of 2021 into 2022, where we're kind of earmarked by a bit more momentum in terms of the global economy. So the backdrop's an okay one, but not a perfect one, but an okay one. But given how well markets have done, you see here it's kind of a busy page, but essentially what we're doing in the exhibit to the left is just cataloging across the asset classes that we're putting assumptions out for the changes year over year, right? What was the expected return in 2019 and what was the expected return in December of 2020? And you do see there, right, that those numbers generally, by and large are lower than they were a year ago. As I mentioned earlier, right, we've had a good run in the markets. We've got low very interest rates. We've got tight spreads. Those all create hurdles on a go-forward basis in terms of capital market return potentials. And you see that pretty amply reflected here in terms of where we think returns might go. Again, we'll see how this all comes together momentarily in terms of the town's portfolio. But just to highlight a few, U.S. bond there, if you can make it out, we expect over this 20-year forecast period an annualized return of about 2%, right? You're not really something to write home about. There's other segments of the bond markets, and you're utilizing some of these in your program, like dynamic bonds that offer up a little bit more return. You've got some high yield exposure under the hood with a couple of the managers, and you see a slightly better return profile there as well. And then you see equity returns running somewheres on the order of, call it six, I guess the range, right, would be 6.3% up to as high as a little more than 9% for emerging market equities. But really the story here, right, is this takeaway, and this is this trend I know we've talked about in conjunction with your actuarial reviews that you do, that just the industry is becoming, more and more cautious and has been kind of pressing down these return expectations and a pretty consistent manner over the last several years. So just something to be mindful of when we look at the output here in just a minute. So anything before we dive into the actual results, anything from the group just in terms of the process or the very high level outlook in terms of our expectations? And again, this will resonate with everyone, I think, in just a minute, but relatively straightforward, I think, right? Mitch?
Yeah, Chris, looking at this page here, I guess this, and tell me if I'm wrong, I think this helps validate us continuing to lower our assumption rate. Looking at, what was, whether you call it a good year or a bad year in 2019, it looks like our expectations are dropping for 2020, or will already have dropped for the 2020, and therefore lowering our assumption rate is probably a smart move in light of this. Does that make sense, the statement?
It does. Absolutely makes sense, Mitch, right? And your intuition is spot on, right? I think on a go forward basis, as we look about what the portfolio may be able to do, it does, right, put downward pressure on those expectations. So I think your interpretation is absolutely correct. I don't know what I do think we are getting to a level, God willing here, let's hope. I do think we're starting to come into some level, right, where we can probably put the brakes a little bit on these calls for continuing to reduce these expectations, right? I wish I could. I can't give the board a definitive answer on when that stops, but we're at 6.25. You're 50 basis points lower than the statewide averages already. With an allocation structure that's not all that different than most of your peers. So I don't know where this exercise, Mitch, stops, right? Is it 6% kind of where we can land and live for a while? I think there may be an argument developing for somewhere around that range as being kind of the point where we can pause on these type of conversations. But 6.25 is, I think, as you all well know, you've been very conservatively managing that, and again, to your credit, to the extent that the town can stomach it, and I think it really does put you in kind of a good standing versus what you're seeing, more broadly statewide. Everyone is indeed coming down, or at least having the conversations, but you've done it at a better pace than many of your peers. Again, to your credit.
Thank you.
That's a good way to think of it. Anything else? Barbara, Eric, anything on your front? John, anything that doesn't make sense just in terms of the process or the backdrop?
No.
Everyone's okay? All right, let's look at, so here's a lot of numbers jammed onto this page. So again, this is a 20-year forecast horizon. And you can see there in kind of the blue row, if you will, you see how we've kind of highlighted your existing allocation at a high level. And then we decompose it, as you can see, in a host of the different asset classes that you're utilizing in a more kind of discrete manner. And you do see there, Mitch, is, to your point, you do see there a calculated number of 5.8%, right? So bear with me on that, and we'll give it more context in a second here. And then what we let the model do is we say, okay, let's see, what do we actually need to do from a simple allocation perspective to generate that 6.25 return? This exhibit, this table rounds, as you can see, but that's essentially what we're doing in the mix one. And you do see no surprises, right? All things equal, what does it need to do to generate return, right? It needs to add to equity at the expense of fixed income. Essentially, you see that in this series of numbers here over in the upper left of the exhibit, right, where we just show you those broad asset class comparisons. This does not, as a reminder, right, this does not encapsulate any type of expectation in terms of managers contributing incremental return. And that'll be an important consideration and data point for you in just a minute, because you do obviously have a plan that is consistently, has a history of consistently doing that. Without getting into all the gory detail for the board, the portfolio does kind of plot optimally. What do I mean by that, right? This is, I think many of you have heard the term before, this idea of the efficient frontier, or that kind of optimal mix of risk and return kind of across the spectrum of more conservative versus more aggressive. These are all statistically equally desirable outcomes. It's just a matter of where the investor intent, needs to reside from an objective standpoint, right? So you can move up to the northeast on that curve. You can get more return. It comes with a touch more risk, right? That's kind of the basic relationship. So the portfolio, no surprise, right? You've got a balance, kind of a 60-40 equity fixed income mix, and you kind of plot right where you expect to, right? And basically almost square in the center of that frontier. So the portfolio is well diversified. It's kind of utilizing asset classes in the manner and the general sizes that it should be, and your portfolio construction, is otherwise well specified. Except the shortfall there just on the surface, and again, then we will start to weave in a couple of minutes. The larger discussion around, well, do we have enough equity in the program to get us where we need to be? I'm going to make the argument to you that I think that you do today, but I did want to, at least for the consideration of the board, show you the relationship there. And if you were to come and say, foot in the sand, line in the sand, we don't expect any type of manager contribution going forward, it's not going to happen. What do we need to do to the allocation? Right, we would need to add a little bit in equity, again, at the expense of the fixed income portfolio. So that is the asset allocation analysis. We do it formally once a year. If we get wacky circumstances, we'll do it more frequently. For example, last March, when we had the big shock down in the markets, we did rerun these analyses, and let's all hope that we don't have to deal with that in this calendar year. But if something like that were to happen, we'll update these and kind of share the output with you. So that's allocation analysis. I am going to quickly go through the market update, because I think a lot of you, I know, stay attuned to this and have a pretty good sense of what went on. It was a good quarter in the capital markets. The display here of global equity returns is the proxy we're using to kind of make that point. And you do see there from start to finish a little bit in fits and starts around the election and some other noise. But generally, you see global equity markets turned higher, and that appetite for risk that's been on display since last March, right, has got the fuel in it that continues to have the fuel in it that kind of started the whole thing, right? Lots of stimulus, as we talked about. So the authorities have got all stops out to kind of provide support. Vaccinations that are starting to get out there, hopefully, and maybe we can turn the corner on the pandemic. Corporate earnings have been a touch better, all things considered, than I think investors had first handicapped, and that has kind of set the table for what has been was a stupendous year in the markets, as you know. We will go through all these, but you can see here for the quarter in the middle of the page, very strong equity numbers around the world, and pretty solid full 2020 numbers as well. Fixed income numbers were pretty darn solid also, right? Certainly for the year they were, given where rates have been, although in the quarter a touch more muted, right? Because interest rates by then had kind of reduced as much as they could have. Credit spreads had condensed about as much as they had, and the returns, while positive, not quite to the same extent they were for the full year. So again, the takeaway there, hopefully for the group, is a pretty good year. I'm going to skip over this page other than mention that you see some of the data points here, evidence and indication, right, that under the hood here economically, we continue to see some of these data points actually can solidify and stabilize. And certainly the world and investors are expecting, right, that we're going to begin to grow and grow more consistently in 2021 and certainly in 2022. And I should say, right, because we get the question a lot, inflation remains very well behaved, as you all know, right? It's down below 2%. And our suggestion would be certainly for the balance of the year, there's still enough slack, right, in the economy that we don't, and the labor markets, for example, that we don't think inflation is a pressing concern near term, although longer term, that may be a different conversation we'll have as all this stimulus starts to unwind at some point. The only thing on this page, the equity market update page, on the bottom half of the page is an important point and one I think that really drives home in terms of the portfolio this quarter and how well it did, was this broadening pattern of capital market returns. So you'll remember back in March when everything fell out, markets all went down. And then on the front end of the recovery, it was the large cap growth stocks in the US that did particularly well, right? A lot of those kind of stay at home tech stocks, the Googles and the Amazons and the Facebooks and those type of things were really the stocks that were driving the broader averages. And it took a while for other segments of the equity markets globally to begin to catch up. So small cap names around the world, value as a style versus growth in the fourth quarter really started to come back and outperform, in fact, those large cap growth names. And that's important. One, obviously, right, it's an affirmation of being diversified in the portfolios the way you are. That's for certain. But also historically, just from a context standpoint, when you've seen these patterns of broadening capital market returns previously, oftentimes they kind of are a foreshadow, kind of the onset of a new economic regime. And that's kind of what we're thinking may be happening here, that as I mentioned, if everything kind of turns the corner on the pandemic front, there is, we think, a lot of pent up demand around the world. And we do think we could have the makings of, the start of a new economic cycle. And these type of return patterns you see here have often been kind of hints or clues, if you will, a little bit ahead of that type of an economic regime really taking hold. Fixed income markets, right? Again, the challenge here is interest rates are still very low, although they have ticked up a little bit higher more recently from a historical context there, right? Rates are still very, very low. And again, those incremental spreads we talk about all the time over here in this exhibit in the lower right-hand corner of the page, you'll see how they've continued to condense, get tighter, right, since the markets have begun to repair from the March timeframe last year. And this is also a byproduct, as you all know, right, of all that stimulus we talked about and all the liquidity that the Fed is putting into the markets is keeping those figures well behaved and those markets functioning pretty effectively. I'm going to skip this page. I think we've probably hit on all of these items here. We'll come back when we have the allocation discussion of some of these themes and talk to you how it kind of works in terms of the portfolio and where you stand today. We don't have particularly strong preferences across some of these different, type of markets, but we do lean a little bit into equity because rates are so low and there are some interesting valuation opportunities, we think, in emerging markets. And while those credit spreads are tight, as I mentioned, base rates are very well behaved by and large, and the fundamentals are still such with all that Fed support that we think while yields are a little bit lower, you're still receiving decent and adequate compensation in some segments of the bond markets. So here's that segue over. Let me do this in fairness. Any questions from the group just on the general economy or background or markets before we look at the portfolio details?
No.
Barbara, you're okay? Mitch, you look okay? Eric, I can't see you on my screen, but I'm assuming
I'm good.
Chris, I got one question for you.
Sure.
You had addressed inflation and potential of inflation. What do you guys see in terms of, if you look at our economy today versus what the economy was, 40 years ago, which, it's a lot less labor intensive. Manufacturing is more automated. It's more service economy than people working in manufacturing. How does all that play into potential? Because they were talking about inflation from wages, but if you can run a business with less people, is that really just take inflation out of the picture?
Yeah, it's a great question, Eric. I think the jury is still out, but I think there is this growing intuition and sense among financial economists, like you said, right, that just the evolving nature of the economy and the way we produce goods and services now, and kind of the flexibility around that, right, on the margin to kind of close and open and come back online and offline. It's maybe structurally starting to change the notion of having these more pressing inflation environments. Because the market and the economies become so adaptable. I'm not sure what it ultimately means. I do think it means, probably all things equal, that inflation is a little stickier than it's historically been, right? Okay. If you look at Eric, like the Social Security Administration's, inflation data, historically, it's somewhere around 2.75%. Maybe even touching 3%. We've been running in the exhibit here, as it's sub 2% now for an extended period of time. And even when we've got these little blips up in terms of strength in the labor markets, we've had a couple of them here, not too many. The headline numbers and the core PCE number that the Fed looks at are still, you see there, sub 2%, right? And then if you kind of marry that, to this idea that Chairman Powell mentioned last fall about the Fed being even probably more patient and letting inflation even run beyond 2% a little. I think that's an indication in their mind, right, that they don't have to worry about a runaway inflation situation, that they can dampen it down pretty quickly, even if it goes a touch over those historic thresholds, that they've always managed to. So, okay. Yeah, I think you're onto something, right? I think there is a dynamic there that means inflation may kind of bounce around somewhat tighter ranges than it historically has.
Okay, thanks.
That was a good question. So, John, you look all set. No questions on your front?
I'm good, thank you.
Oh, great. Okay, here's the portfolio at the end of December. We're a little north of $28 million. As you can see, $28.2 million. To the conversation or discussion of allocation there, you do see on the surface, right, a little bit in the way of an underweight to fixed income. Probably not as pronounced as it looks in the exhibit, right? Because I would, in my head, kind of pragmatically throw the cash reserve in alongside that when I'm just thinking about the portfolio more broadly. So between cash and fixed income, you're at about 37% of the portfolio at the end of the year. Slight overweight to equities, at the expense of that, not dramatic, but a little bit overweight. And again, directionally, I think consistent with our best thinking. And the other thing that's not displayed on the page here, but as a reminder for the board, when we're raising and working with Eric to do that and kind of replenishing that liquidity bucket, we have been drawing pretty consistently from equities as the year came to a close. We did it once in the end of October to the tune of $320,000. And then again in December, we took out just before the holidays about $485,000. And the sources for both of those raises were from equity. So we're kind of naturally, right, using, as we've talked about in the past, that discipline and raising when we need to from those overweight areas. So you're not getting too far afield from the target weights. And I think as we stand here today, given that consideration, I don't have any recommendations for the board tonight. I think we're in pretty good working order on the allocation front. And then I'll pause again in a minute for any thoughts around this exhibit. The only other thing I would say here, because it's a convenient place to do it, we do have the entire roster of managers on maintain with one exception, and that's the American Beacon strategy. You'll remember within your domestic equity category, your value component, is still on watch. I'm going to working with the analyst core on that, so we'll come back to you next quarter. Again, I don't think it's a particularly pressing matter, and in fact, they had a pretty good quarter and have stabilized their returns pretty nicely. But just something to be mindful of. Otherwise, everyone's kind of in pretty good working order and kind of positioned and performing consistent with our, with our best expectations. So I don't know if there's any other questions on just allocation or the lineup or the roster or a particular manager. What we've been talking, maybe what I'll add here, what we've been talking to clients about are things that I think you folks have already done. And that is, we've gotten kind of creative, right, within fixed income. You've got the BlackRock strategy, and you've got Brandywine Global Bond, to kind of work against that yield compression that we talked about. So I think that's continues to be an appropriate stance. The relationship of domestic and international equity, I think, is about right. The capitalization profile within domestic equity, I think, is about right. Leaning a little bit into the value, right, which is continuing to perform pretty strongly, makes sense. If you look under the hood with international equity, the one thing we may come back to and talk to you about, but we don't feel the immediate need to do it, is the amount of emerging market in the program, right? We don't have a dedicated emerging market equity manager, but you'll remember Dodge and Cox, about 15% of their portfolio, I think, is in emerging market equities. The Euro-Pacific Fund, I think, has about a quarter of their program in emerging market equities, and Templeton runs it probably maybe 20% as well. So you are getting that exposure by virtue of these managers, but that may be something we explore in the future. And we've got REITs, which again, I think continue to be an appropriate place. We have had some discussion from clients, to Eric's point, but it hasn't seemed to be really immediately pressing, because again, I don't think anyone thinks inflation is coming running down the pike at us anytime soon. But we have had some people talking about expanding their inflationary protection buckets. You'll remember we used to have a higher weighting here in the past, and I think in our kind of our collective best thoughts, you'll remember we reduced that. And I know the board was interested in doing that. So I don't feel the need really to come back to that space just yet. But if we start to see some troubling things on the inflation front, we may want to start to think about some other type of strategies alongside tips that can offer inflation protection. REITs do a little bit. Equities in the broadest sense, right, offer up some protection to inflation, but there are also things like infrastructure and natural resource equities that do it, and those type of things that might be of interest at some point down the road. But again, I don't think we need to do it now. So that brings us to the big show here, and I think where we'll leave it, and that is performance. So just on the summary page, you'll see for the quarter, it was a nice quarter for the portfolio. It was up just shy of 12% net of fees. So nicely ahead of the benchmark you see there that was up about 10% for the quarter. I dare say, right, who would have thought a one-year number back in February, March, we'd be running off a 14% year in a pension portfolio, right? You never would have guessed that given how dire the circumstances were, but it does speak to the resiliency of the markets, and you had a nice outperformance there, as you can see for the year, up over 2.5% more than the broad markets were. And that return is obviously impacted and benefited the longer term results as well. And you do see that restoration of a pretty consistent incremental return profile versus the broad markets, which of course is nice to see. And then maybe just the concluding thought, right, to come full circle. So we've got a 6.25% return expectation. The portfolio, as it's allocated today, models to about 5.8%. You can see here you've been running longer term, right? Somewhere around 40 to 50 basis points above benchmark. if the board's willing, right, you can, I think, take credit, and I'm sure no one in the actuaries included would press back on this. You stack that on 5.8 and you come into a number, right, that just comes actually kind of neatly and coincidentally comes right into something akin to your 6.25% assumption. So I don't feel the need to have to change the allocation right now, even though the surface number appears a touch low given this history. I think 6.25, right, as you've got it, and kind of the way we're allocated right now is perfectly appropriate. But I'll maybe pause at that and get a reaction, if any, from the board.
It looks good.
Yeah. I guess, Chris, the interesting part is that our actual returns since inception are very close and tied into what your asset allocation model shows. So
Yeah.
So we are matching. Everything is really, I guess, matching up to what the expectation should be.
It does speak a little bit to this concept, right? Over long periods of time that markets kind of mean revert, right? And they kind of come back to, you get lots of, right? Look at the calendar year numbers, right? Are all over the map. 14.6, 14.3, 5.3, down 80 basis points, up 6, up 15, down 7. Remember, 18 was a miserable year, you'll remember. And then 19, a strong year, and then another strong year in 2020. So you're right, Eric. It is kind of interesting. That is another kind of a point of note there, or kind of a good data point, hopefully, for the board to say, it's about where we've been over long periods of time. So maybe that is about right.
Chris, is that, as you just indicated, so if you look at the last box, there should be one now for 2020 that would read 14.3. Is that correct?
Yeah, so it hasn't rolled down just yet, Mitch. So you're right. The 1 year number there is basically your calendar year 2020 number. Yep.
Thank you.
Okay.
You know what we don't have in here? I thought we used to, we maybe put it in the flash report. The other thing under the hood here, just as a preview, knock on wood, it is shaping up to be a splendid fiscal year, right? If you think about where you've come from since July, let's see, maybe we can do this. So you were up 12% in the fourth quarter, second quarter of the fiscal year. I think I've got here, let's see, the first quarter of this year, third quarter, right? Or the first quarter, 5, 6, and 11.8. Everyone see that? Right, so that would be your fiscal year to date. You can't really add the numbers together. You'd have to kind of geometrically link them. But nonetheless, your fiscal year to date, you're up, 16.5%, 17%, something like that, in the first 2 quarters of the fiscal year. So we'll see how that fleshes out. But just has got another data point, I suppose, to kind of look at. The work product here is, if you're inclined, if you want to get into the detail of the managers, as you know, you've got that warehoused as well. So I don't know. That's all, Mr. Chairman, I had for prepared remarks, but happy to stay on as long as the board would like to.
I would just say, is there any questions of Chris from anything that he's brought up?
Not for me.
Okay, because I think the only consideration, and really, Chris, going back to your and you may have talked us out of it just from going through all of the numbers, but just going back to your asset allocation, and the fact that our current mix is a little lower than what the target is for what we need to achieve our plan of the 6.25%. So I guess the question to the group is, and we don't have to, this is something we can even think about, is there an appetite for making a modest reallocation of our assets to slightly heavier equity and a little lighter on fixed income, to try to, make sure that we hit our expected returns more frequently. Or, are we comfortable where it is?
I think this is an allocation that's worked for us for quite a while, and who knows what will happen next. And I feel more comfortable staying with what we have.
Yeah, I would echo that a bit and just say, leave it to our recommendation from Chris. I mean, if he feels that we should be reallocating, I'm sure we usually take his recommendations.
Yeah.
So I would leave it to his recommendation of what he sees, not just what it's been, but obviously what he foresees in the near future for us. And if he feels that we should be reallocating, then we can discuss it further. Right now, I'm comfortable with what we're doing. The performance looks good, and let's hope we keep that up.
Okay. Any other questions, comments? Something to mull over for Chris? Is there anything that anybody's looking for going forward this year, that that hasn't been addressed?
The only other thing I'd say, and Eric, it kind of dovetails a little bit after what you were talking about in your question about inflation, and Chris, coming out of the pandemic, which we're certainly hopeful in seeing. Unfortunately, I see, and this is just me speaking, I don't have any economic background to say this, but I see the country in two separate pieces. One piece has been hurting economically. The people that have needed the stimulus money, the businesses that have really suffered during this pandemic. And then there's people that have continued to work. Some have done very well based on the pandemic has actually fed their business and their incomes, but they haven't been able to spend it. And so, nobody's going on vacation. Nobody's, and so, the big ticket items, people aren't driving as much. So they're not even buying cars, I don't think. But the point is that when we come out of this, do we see that there's a pent up demand of people with money ready to spend, and that will drive an inflationary factor into this, unfortunately leaving some other people behind even more if inflation takes over. And so with all that, should we be positioning ourselves with a little bit more inflation protection?
I think it's a great.
If I'm totally wrong, just tell me.
No, I don't think you are, right? I think your statement is absolutely true, and we've seen it in some of the data as well, right? You do. When on the margin, we've had these little instances, right, where we've kind of felt better about the health situation. Last spring, you'll remember, for a little bit of time, and there's been a couple other little, these very truncated periods. You do see these high frequency numbers, right? Restaurant reservations go up, Uber rides go up, sniffing around travel sites go way up. All these kind of green shooting data that economists look at now to try to tease out some of those trends. So I think you're absolutely right. I think the market is expecting, right, that when we're able to kind of do it safely, there's a ton of pent up demand for services and goods that hopefully will unleash. And that's the basic MO that a lot of people put forth that say, I think you better watch out for inflation when that happens. I don't know that happens anytime in the next several quarters, right? I think that is more of a secular thing that would need to take hold over the course of a year and a half's time. But it's something to be kind of mindful of. I think it's something we look at, monitor on your behalf. And you're right. I don't think we need it just yet, but there could be an opportunity to add an element more of inflation protection into the program somewhere down the road here.
Yeah.
Maybe not just yet, though.
Thank you.
Yeah, and Mitch, I think you're right. If you look at elements, we look at housing, housing prices, especially around here, have even in an overall quote unquote bad economy, housing prices have really, skyrocketed. So there is pockets and elements of inflation that are out there. And maybe in some cases a bubble that is going to hurt down the road, but who knows?
But maybe what I'll do if it doesn't, if the board is okay with it, I think I'll have us, let me bring some inflation information to our next meeting, right? I'll bring you some thoughts just around what people are doing in the space and how they're doing it. For those that are kind of looking at it, it might just be the basis for an interesting conversation. So I'll make a note of that, and we'll maybe share some of that detail with you next quarter.
Thank you, Chris.
Thank you. Okay. If nothing else for Chris, looking back to our agenda, next item we have, and John, and we talked about this the last meeting, was a possible date to meet with the Board of Finance. I don't know if that's gotten anywhere, John, or because of the season that's kind of on hold right now.
Yeah, they kind of set up a tentative date for you if you guys can make it, and I was to bring it back to you. I believe that date, and I can't see my calendar right now to get to it, May 20th. I believe that's the third Monday in May.
I think it was May 17th. Let me double check.
All right. Could you do that for me, Mitch?
Yeah,
May 17th is the Monday.
The Monday.
I think that's the regular Board of Finance meeting. They were hoping that we would be able to attend. And so, and I'm not even sure they were looking to meet with us, Barbara, Eric, and I, as much as they are looking to meet with Milliman and DeMayo Schneider. Because I think those the questions they're looking to get answered are some of the ones that we ask all the time. I think, John, that's how I've read it. I mean, so I think that maybe John, if you think this is correct, maybe our best bet, and tell me if this works for everybody, because otherwise we don't have a quorum, is if we can make our meeting in May, which is supposed to be 3 days later, move from that Thursday to that Monday, the 17th, and then we can hold our meeting kind of simultaneously with the Board of Finance, maybe separately, and then go into their meeting and then out of their meeting or whatever they want. But it's important not just for the three of us to be there, but it's important that that our representatives from DeMayo Schneider and from Milliman can be there as well, I think. John, is that the take you get? Because I listened to their discussion at their last meeting when this came up.
I'm not sure they understand what they're looking for. I don't think we have to go into a deep dive the way we do with Chris here, but it's probably a good idea if he could be there. I think the main thing is Milliman, and I think they want to hear that the pensions are healthy. They may want to hear what the reasoning was behind dropping the rates the past 3 years, because that's certainly affected the budget at the time. I don't have any problem with you guys meeting the same time with them and then going into your own meeting. I just can't be at two places. So if it's okay if I be at one and not the other, probably the Board of Finance more importantly, or I could try and get Audrey to help cover me at one of them.
No, I'm thinking that, we just enter their meeting. Maybe, John, if it can be set up this way that we're the first part of their meeting.
I could do that.
And then when they're done with us, we can then break away and conclude our meeting if there's any other business we need to attend to. But I do think, I agree, they want to hear from DeMayo Schneider, they want to hear from Milliman as our consultants. But I also think that since we're the three people that have voted on these recommendations, that we be, as the town representatives, we be there as well to explain, defend, or just help them understand what our thinking is and why we're doing what we're doing, which is mainly we're following our consultants.
I want to hear their questions because, it'll come back to us in one form or another. I just as soon hear them directly.
Right.
And ultimately, I think the numbers that Chris has shown us, kind of tie right into what everything seems to come together. I mean, the numbers tie into what Milliman is recommending to us, which also ties into an asset allocation strategy. So so all these things, and I get it. Board of Finance, if they're just seeing, well, we're making these reductions in expectations, and it's just costing the town more money. But there is a reason behind it. So
yeah, I don't think they have any problems with what you're doing. I think it's more of a process with them that they meet with the different department heads and the bigger ones, and instead of this being a department head, it's just a big line item in the budget that's been growing. I think this happened maybe. And Mitch, I think you were the first selectman. I was on the Board of Finance, and I think Richie Meisenheiser was on the board at the time too. And I think we had a joint meeting back then.
It could be. But that's obviously a long time ago now. But I agree, John. I don't think they're being necessarily critical of what we've recommended as much as they want to understand why we're recommending it. And I think it's a great idea, for us to get together. I think it makes all the sense in the world. And I think you're also right that they do meet with department heads. And quite frankly, the pension line item is a very large one in the budget. So they should meet with the department heads, which basically is Eric as the chair, and the rest of the committee, which I think is fine. I think it's perfectly appropriate. And I look forward to the discussion. But once again, I think it's important that it won't bode as well with just Eric explaining what we do without having Milliman and DeMayo Schneider there. So
no, I agree. So why don't I do this? Well, I'll first have to start with our 3 pension members, or 4 if the 4th one comes. Is the 17th a good date with all you guys?
It is for me.
Yeah, it's fine for me.
Yeah.
Okay. Chris, is that a good date for you? Can't hear you, Chris. You're muted.
Yeah, I just noticed when I started yapping. Let me see here. I don't think that there's any issues. No issues with that date.
Okay, so I'll then check with Michelle if it's good with her. We have a meeting, Board of Finance, Monday night. I'll bring it back to them, joint meeting, and then you're going to adjourn to your meeting, and they'll adjourn to theirs. Their meeting probably won't be much because it'll be right after the budget vote on the new budget, or it should be right after the budget vote.
Well, let's put it this way. It'll be a quick meeting if the budget passes. If the budget doesn't pass, it may not be a quick meeting.
That too. And I can't say whether it's going to be Zoom or not because the governor's executive orders run out. I believe it's April 20th. So until he extends them again, if he does, we may have to go out of Zoom and go back to meeting as a group again.
So Eric, let me do this. Let me make a motion that we move our May quarterly meeting from May 20th to May 17th, if it is acceptable to the Board of Finance and we can get someone from Milliman to be there, since we know everyone else can be there. That's a long motion, but you know what I'm trying to say. And if it doesn't work out, we'll just leave our meeting date the same.
Second.
Yeah, I think the motion would be that we move the meeting from the 20th to the 17th, contingent on the Board of Finance and Milliman.
There you go.
Okay.
That's why you're chairman.
Sounds good.
My second covers that too.
Okay, we have a second. Any other discussion on that? I don't think so at this point. So all in favor, signify aye. Raise your hand.
Aye.
Okay, that's all in favor, none opposed. So so John, let's see if we can get the sun, moon, and stars all aligned on this.
Okay. And then one other thing on our open seat here, as you do know, I think I reported at the last meeting, the letter did go out to the union. At first, there was no response. And then there was a response that they were thinking of maybe asking a retired member that draws a pension from the town if somebody there would like to do it. But I've heard no response from them yet. And part of the problem is the union president, who's an employee of the town, has been out quite a bit. And so we haven't been able to get in contact with her. So I've been going through another party, and it's not always the best way to do it. But I will follow up on that between now and the next meeting. They don't seem to want to, at least at the moment, they don't want to seem to give up the seat, but they doesn't seem like they're able to find anybody that wants to do it either.
That sounds like status quo to me.
That's what it does.
So, I mean, between that and our police union representative, that's, not doesn't show. I mean, again, I think we've talked about this in the past. It's really, a shame that, that these are things that are bargained for, and then the unions aren't taking advantage of it for, what they work for. So
I guess it's a good incentive for the three of us to stay healthy, though.
It's made it easier,
so.
like a night like tonight too, with the Zoom.
Yeah.
Yeah, we're doing such a good job. The only other, and it was mentioned in the minutes, sometime later in this year, and we've talked about this off and on the, we really just spend one meeting a year on the DC plans, the 401A plans, and we've been with Mutual of America. It's pretty much been the status quo. Is there anything or any interest among the group as to looking at that side? I mean, we're up to almost $24 million in assets on those plans, on that plan. So, should we be doing anything more on that, or is everybody comfortable with where we are?
Weren't we going to look at what options were being offered? It just seemed like a pretty big smorgasbord that was out there.
Well, that's the thing. And Mutual of America, I believe in the board minutes, from the meeting, they indicated that they were going to be changing a lot of their fund options and possibly adding more. And is that something that, and I think, Chris, you had mentioned at the time that maybe in terms of, instead of offering 60 or 70 options, that should be kind of narrowed down for town employees.
That's a move that runs counter to the trend in the industry, right? Because you offer that many options to a participant. I know on the surface it seems desirable, but the participants don't know how to analyze it or utilize it, right? So certainly the trend has been to much tidier lineups, right? And the two-tiered kind of approaches. We offer up a little bit of indexing and active management across the risk return spectrum for those participants that are inclined to try to do it themselves. And then we have some type of a target date, right, solution where the participant can just go in with their age and demographically get put into a portfolio automatically. And 50 or 60 options is way off market for what you're seeing is kind of best thinking right now, for what it's worth.
And we have an awful lot now, even without the addition.
Yes. So I guess the question is that something of interest that we should be looking at, either culling that list down, getting some assistance to help us to cull that down, leave it as it is. My personal feeling is similar to Chris, that you end up with kind of a paralysis. People get overwhelmed with too many options, and what do? They just put it in a fixed return, which gives them, really doesn't give them much of anything, but they understand it. So that becomes the default. Or
they get advice from the wrong people.
So, and John, I don't know, have you heard from them about any, they said first quarter of 2021 to roll out the changes. Yeah. Has any other information come up yet?
No, and I've talked to them for our deposits with the new computer system. We went to a new way of getting the deposit money to them, and they haven't mentioned anything. But I agree with Chris. My past training on this is you kind of give them one or two funds and in the different breakdowns of categories, and you let them pick, but you don't have anywhere near 60. Even to my feeling, 20 would be too many.
Do we ask them to look at this and make a recommendation, and then we can get whatever additional insight we need?
Well, they're not gonna bring anything on without your vote. So they're gonna come on, and I would say, and I've never gone through this with them, but they're probably gonna come in with some recommendations. Maybe, I think, Eric, you would talk to Chris about this. Maybe we get some help from Chris on that side of it too in the future.
Yeah.
I don't think it'd be a bad idea or somebody else looking over their shoulder on some of this.
Okay. Well, why don't we do this? Why don't we wait and see what they come up with, and maybe for the May meeting they'll have their recommendations, and then we can address it at that time as to how we want to proceed. Maybe either getting Chris involved or narrowing it down. But yeah, I do have a concern of offering every mutual fund under the sun to employees, and they're just getting kind of lost in the morass of too many options. So okay. So any other items to bring up? John, anything else have you heard relative to Wells Fargo? Any changes there, or things are still working fine?
Everything's still working pretty good there.
Okay. Always want to check in on that.
No, it seems to be going pretty good there. And I think they're a little unlike Chris's merger, if you want to call that. Theirs, I don't think is going as smoothly with theirs, because they have backed off on some of their target dates, as we've heard, but and they're blaming on the COVID, I think, but that seems to be the easy escape right now.
Yeah. Well, if they're the offices that I send stuff to are down in Texas, so hopefully they have backup power. But
I wanted to ask, at some point when they changed the required minimum distribution age, we had talked about whether we were going to get any plan amendments. And I don't know if those ever came through or ever discussed.
I don't think any amendments came through. The last amendment, I think, was for the first responders, wasn't it, Eric? Or you did sign something one night when PM was here. I forget what that one was.
yeah,
I think it was the lowering of the age for the first responders as
for early distributions,
right. That's what lowered.
or in service distributions. Yeah.
That's right. But I agree. I think we should take a look at that. If the RMD has changed and we need to update our plan with an amendment, we need to do that, I guess.
Okay.
All right.
Okay. Yeah, we can address that. Any other questions, comments, old business, new business? And if none, then I would entertain a motion to adjourn.
Motion to adjourn?
Is there a second?
Second.
All in favor? Aye. So our meeting's adjourned at 8:03. We got a nice, efficient meeting. Thank you very much.
Thank you.
Thank you. Bye-bye.
Share that with everybody.
Okay, great. Because what I noticed in looking at this was it was a considerable increase from